Hi team! Today we'll be covering the topic of risk assessment within our audit software. Risk assessment is the process of identifying and evaluating the risks of material misstatement in financial statements. It helps us understand where errors or fraud may occur and ensures that our audit procedures are properly designed to address those risks. In our software, risk assessment is divided into three categories. 1. Inherent risk, the susceptibility of an assertion to a material misstatement, assuming there are no related controls in place. This looks at the nature of the account or transaction itself. 2. Control risk, the risk that a material misstatement will not be prevented, detected, or corrected in a timely manner by the client's internal control system. 3. Detection risk, the risk that the audit procedures performed by us fail to detect a material misstatement that exists in the financial statements. Let's now focus on inherent risk, and within it understanding client business. This section focuses on gaining a deep understanding of the client's nature of business, industry, operating model, and environment. It covers areas such as the client's revenue streams, cost structure, competitive landscape, regulatory requirements, and key management processes. By understanding these factors, auditors can identify areas that are naturally prone to misstatement or fraud, especially those involving judgment, estimation, or complex transactions. The concept of significant risk. A significant risk is an identified and assessed inherent risk of material misstatement that, in the auditor's judgment, requires special audit consideration. These are areas more prone to error, manipulation, or fraud, and hence demand heightened scrutiny. The software provides us with a significant risk assessment screen where common risks are listed along with guiding questions. For example, a misstatement of revenue recognition. Our revenue recognition policies bias toward premature or inappropriate recognition, leading to overstated profits. A inadequate expense recognition. Our expenses understated or deferred to future periods to artificially inflate current profits. A manipulation of financial instruments. Is there bias in valuation or classification of instruments that could misstate performance? Improper asset valuation. Is there bias in valuing property, plant, and equipment that overstates asset values and understates depreciation? For each risk, the software prompts us to mark whether it is applicable, assign it to relevant primary and secondary areas, provide an assessment, classify the nature of risk, and add remarks if needed. The small eye icon next to each question provides examples of further guidance to assist the auditor in making the right judgment. At SA 250, consideration of laws and regulations in an audit. This section addresses the auditor's responsibility under SA 250 and equivalent global standards to consider noncompliance with laws and regulations that could have a material impact on financial statements. Auditors document whether there are risks of regulatory noncompliance, e.g., tax laws, labor laws, environmental regulations, and assess their effect on inherent risk. It ensures that potential legal or regulatory breaches are factored into the risk assessment process. IT environment risks. In today's audits, IT plays a central role. This section assesses risks arising from the client's IT systems, applications, and controls. Examples include risks from unauthorized access, weak cybersecurity practices, reliance on outdated systems, inadequate change management, or lack of segregation of duties in IT. These risks can directly impact the integrity and reliability of financial reporting. By identifying IT environment risks, auditors can determine if further ITGC, IT general controls, or automated control testing is necessary.